All right. Welcome, Cayenne, to week 4. You made it to week 4, the final week of this MBA course. And hopefully you feel like you're on top of things, or at least have this week mapped out on how you will get caught up and be able to get everything in so we can get you the score that you would hope for from a class like this. As I've mentioned before and proposed before, if you get stuck or caught anywhere, I'd strongly encourage you to be in touch with me right away on anything that you're caught on. I think the main thing at this point is I just need to see your assignments, and they're just short answer questions. So if you'll go back through and make sure and get all those assignments done, you'll be in great shape. So tonight, of course, the priorities are to cover some of the material from the chapters that were assigned, and then spend most of our time going over the topics that you'll need to know for the test. A lot of the problems on the test are repeat problems. It is comprehensive from previous chapters. And of course, this week, as the readings and as the chapter information shows you on our website, we're going to be looking at chapters 23, 24, and 26, primarily about ways that companies raise capital. And so tonight we'll be using primarily slides from 23 to look at, but we'll also potentially get to some of 24, most likely not have enough time for that final chapter. I will email you the slides, though, as always, and that should give you an opportunity to review those, but more importantly, the book and the chapters and reading is what helps you to really understand these concepts. Trying to think of anything else we need to cover before we jump into chapter 23 and the slides from chapter 23. Tonight we'll take a little bit longer with the final review. There are 90 questions on the final, and of course it gives you lots more time. You've got up to 3 hours to take the final, but just be careful that you don't underestimate how long that might take to take the test. So just make sure that you've adequately prepared for the final before you start it, so that you don't have to end early and have an incomplete test or an incomplete submission for your test. This test, the final, of course, is worth 180 points, which is almost 20% of your grade in one test. So it's a great opportunity to get a lot of points and to be awarded a lot of points. It's also can be a liability to your score in the class if for whatever reason we're not prepared or not studied up to take it. Okay, so a couple of additional things I did want to cover. We've been talking in this class about the market, the stock market. We've been talking about how companies raise money and different company types. And tonight, as I mentioned earlier, we're going to be talking more about how companies really are able to raise capital, raise money to grow their businesses. One of the things I did want to point out, some big news lately in the market. Friday, the market went down over 300 points, which is the largest decrease in quite some time in the market. So it was a pretty scary day. One of the Federal Reserve Board members had come out and said that basically, a rate increase was still on the table. The market had assumed that no more rate increases would happen this year, and we got that kind of reaction from the market. Then today, we get an opposite remark from a different board member of the Federal Reserve that basically said we should not anticipate raising rates because the economy is still fairly weak, and we shouldn't be going against what the whole rest of the world is doing, which they're all being more accommodative as far as their federal policies, and most countries are bringing their rates down or even negative. And if we try to buck that trend when the economy is kind of in a precarious circumstance, we'll send ourselves into recession. So basically the market responded well. We popped over 200 points today. Almost recovered what we lost on Friday because of a comment once again. It's amazing that the Federal Reserve comments have that much power to drive what the market does, but that's what's been going on recently. You remember that last week we talked a little bit about the difference between the primary market and secondary market. We talked about how what you and I see as the stock market, like the Dow Jones Index and the S&P 500, and how it moves is a representation of what people are investing, how people are investing with each other, right? The stock market represents you and I buying and selling from each other. It's not about companies buying or selling their stock. It's about individuals and investors buying and selling from each other. And what we're going to focus on tonight is the other side of that, which is, and we talked about a little bit or alluded to it, but it's that initial public offering, which is when a company goes public, what we call going public in an initial public offering or IPO. And that's when they offer, most times, well, if it's an IPO, this is the case, that when they're offering their stock for the first time to the public to invest. So one of the slides we'll look at tonight shows that one of the largest IPOs of all time was Facebook. Actually, the largest IPO of all time, the biggest one as far as how much money was invested, was Visa. That was a few years ago. But Facebook, a few years before that we're all familiar with, did have a wildly successful IPO as far as raising money and being able to grow their business. And most people would say that Facebook has done a pretty dang good job growing their business and also expanding based on that money that they raised from that IPO. So ever since that point, ever since their initial public offering, Facebook stock, if you were to go buy it, you're buying it from an investor, right? Somebody else that's selling it to you. Somebody has to be willing to sell it for you to be able to buy it. Now, on those big companies, there are always buyers and sellers available at a certain price. Some smaller companies, sometimes it's hard. It's difficult to even find buyers and sellers when it comes to a very small, if there's a very small marketplace for a particular company, for example, a very small stock. So out in the Vernal area here in Utah, there's a company called Superior Drilling Products. There's also a company in Linden, Utah called Profire, and these are two energy-related companies. So they both provide equipment to the energy industry that have really struggled over the past few years because of how oil has been doing, because their primary, the primary group that they sell to has been really struggling. So in turn, they as a supplier to that industry has been struggling. But the reason I bring both those companies up is those companies don't trade very much on a daily basis. And so if you were to go in and try to buy a lot of shares, say I wanted to buy $1 million worth of shares, that would actually drive the price up. And if I went in and tried to sell 1 million shares, I might really drive the price down, because both of these companies have what's called a light trading history, not very much trading, not very much volume. So the lighter the volume, the more insignificant the volume is, or the smaller the volume is, the more significant a trade can impact the stock. So if I go in and sell 1 million shares or $1 million worth of shares of Amazon today, I will have probably an immaterial impact on the share price, because there are so many millions of shares being traded each and every day that my million won't have a significant impact. But as I mentioned, with those two smaller companies in Utah, 1 million shares or $1 million, one or the other, either one, would make a material change up or down, depending on whether or not I was buying or selling to that particular stock. Okay, so I just wanted to point out a couple things about what's going on in the market right now. Also bring up, kind of a foundational point on IPOs and when companies go public from being private before. We mentioned in a discussion post earlier in this class that you can go public and then you can also take your company back private, like Dell Computers did. Michael Dell, the CEO of Dell Computer, had a public company for years and years and wanted to take his company back private to have more control over the outcomes of his company. So one of the things you relinquish when you go public is your control, and you don't have flexibility to have 3 and 5 and 10-year goals and be laser focused on those when the market is going to look at your returns on a quarterly basis and judge you based on your progress each and every 3 months. So it's just a really intense scrutiny that gets put on these public companies once they've IPO'd, once they've got public. Get a drink here. Oh, one more quick thing before I forget. There is a 15-point basically course feedback thing. You've probably seen this before, Cayenne, but basically it's just a place to give some constructive feedback for the course. Obviously, you're going to have your course feedback. You might have already gotten that on, giving feedback on how I did as an instructor, how the course was set up, what you felt like, was good and bad about the course. And that's, even though that's anonymous, obviously, as the only student, just be just be aware, that everybody's going to know, that you submitted that. But it's not going to affect your grade at all, as positive or negative, as your feedback is. So I don't worry about that. Just give me some good constructive feedback that I can work with, good or bad, and I appreciate that. So anyway, just thought I'd give a quick plug for that 15 points, because that's, I'd take any points that I can get, and that's one of the easiest ways in a class like this to get 15. Just a reminder, I'm looking for your assignments this week, and fully expecting to see all 3 of them so that I can get you points on those. And if for whatever reason you can't submit the assignments, like if it's locked you out or something like that on your submissions, just go ahead and email them to me as an attachment, no problem. And like I say, let's make sure we get all 3 of those in. All right, so let's talk about capital raising, or in other words, a different way to say that is just money raising. When it comes to the market, that's what we do. We try to raise money. And the point of raising money is to expand our business, right? Gives us the flexibility to grow our business more quickly. So we've already talked about the example of Walmart. Walmart spends millions and millions of dollars on each and every one of its locations when it first builds them, right? So if Walmart were to expand too quickly, they'd run out of money and capital because they'd be spending too much money on these properties that they're building. And so Walmart years ago went public and raised billions of dollars so that they could go out and build multiple locations and accelerate their expansion plan as far as expanding as a company. And of course, over a short period of time, a relatively short period of time, there's basically a Walmart everywhere and almost everywhere in the entire world. And a large part of that is because they were able to do a very successful public capital raise and use those resources, at least some of those resources, in order to, significantly enhance their growth strategy and grow their business quickly. So the initial capital, usually the initial money that a business will use, especially in a small business form, most of the time will come from the business owner themselves, okay, or maybe an immediate family member or friend that's willing to let them borrow some money. Even banks have a hard time giving money to entrepreneurs for their initial idea before it starts to make money. So one of the things that makes a lot of people frustrated with banks is they'll go into a bank and say, here's my idea, I need some money to be able to do it. And the bank will say, well, we're not going to give you any money to do it. You need to go prove that you can do it and that you have sales, and then we'll give you money. So to the small business owner, obviously, that's a point of frustration, because without the money from the bank, many times they can't do their business idea. So it's kind of a chicken or the egg type of thing. The bank isn't willing to give money to somebody who isn't proven as far as an entrepreneurial track record with whatever it is that they're trying to do. And the flip side is some entrepreneurs can't do anything as far as starting a business without capital, and some people don't have sufficient capital themselves to make it work. And so, but as a general rule, individuals that are trying to be entrepreneurs and start businesses must self-fund right from the beginning. Then once they self-fund and get some kind of track of sales or whatever, then they can start to pitch their ideas to the bank, different banks. They can start pitching them to angel investors, VCs, private equity groups, and we're going to go through those different types of groups later tonight in different slides about those. But the point is, it's a lot easier for them to raise money once they have something that's started. Now, some angel investor groups and VCs and private equity groups are willing to throw money at something that's not yet profitable, especially when it comes to a newly patented product or a technology that companies forecast will be very successful. And so if an idea can be pitched well enough, and if there's a forum to pitch it well enough, and if there's a good enough probability that that idea will become a moneymaker, then a lot of times there are groups that are willing to throw money at that idea, even if there's not profitability yet. But a lot of times the banks still won't. So just keep that in mind. So oftentimes a private company needs, though, more money than what they can get from their family, right, to be able to increase their growth. They run out of capital and they need additional capital, and they don't have any of their own money anymore. They got to go get more. Once again, the channel of the bank might be an option, not even an option. And so there are different other channels that they can go to help capitalize their business. And sometimes if they don't capitalize, in fact, the number one reason for business failure in the United States is undercapitalization. It's not bad ideas, it's folks that run out of money. So they get everything going, and they've put so much money into getting it going. This is kind of the curse of the restaurant, right? An entrepreneur puts so much money into building his restaurant dream, that within a few months he can't cash flow, and has to fold. So that's why it's so likely when it comes to small business owners in the United States that they fail. About 1 out of 10 succeeds, about 9 out of 10 fail. And like I say, the number one reason for business failure in the United States is a lack of capital. Because even if you have a bad idea, if you can capitalize it for long enough, sometimes it actually turns out to be okay. But if you have a great idea, even if it's a great idea, you might not be able to cash flow it long enough in order to make it successful. And one of the sad things that I see a lot in my world, as I'm advising clients, is I see a lot of clients with very good ideas, with inventions, with ideas for technology, and because they don't have enough capital, because they don't have enough of an ability to throw money at something until it works, because sometimes it takes some time, they end up giving up on their idea and end up, with all that debt though too. If they kind of went halfway with it and couldn't end up completing the project and couldn't get money from anybody to support it. So anyway, that's an important thing to consider when it comes to business and business capital raises. Is a lot of it just has to do with being able to get enough funds to make it, right? So we have angel investors. In Utah County, there's a group called the Provo Angels, and it basically is just a group of entrepreneurs that have become successful, that have money, and they're looking for other people's ideas and be able to throw money in a very small amounts at companies just to basically get going. But as it says here on this slide, it's very difficult to find angels, and usually there's so many people trying to get their attention, for their limited resources, that it is a very difficult uphill battle to get angel money. The other thing that happens when it comes to angels, at least in this area, is once a small business gets one angel to support them, it's kind of a herd mentality. A lot of times you'll have 10 or 20 other angel investors that'll jump on board, but until 1 or 2 jump on board, like I say, it's very hard to get that first one to jump in. But once one guy sees all his friends and somebody else that's very successful buying into an idea, then it's a lot easier to get additional angel investors. Then you have venture capitalists, and venture capital firms that basically focus on raising money. It's an entity that focuses on raising money from investors to in turn go out and support ventures. Okay, that's where its name comes from. Put a lot of money in. A lot of times they will force a company to have significant revenue before they come in, and basically venture capital can kind of be a bridge before they get to that initial public offering. A lot of times they're leveraged buyout firms, and we'll talk about them in a minute, or venture capital companies that focus on companies that they know they can bridge to an initial public offering, because it's very lucrative as a venture capitalist if a company that you buy into then goes public. Because you get bought out, or you have liquidity to then sell your shares and make significant returns potentially if the company's done well. So general partners on a venture capital group usually charge 20% of the positive return plus about a 2% flat fee. That's consistent with hedge fund fees. It's usually a 2% flat per year and then a 20% of upside. If there's no upside, they don't get the 20%. Okay. And a lot of times they'll have some threshold that the venture capital company has to exceed. Maybe it's a 6% return or 8% return, or they don't get that 20% upside either. Okay. So here's a listing back in 2011 of some of the top venture capital firms. This is way out of date, but a couple of them, like the Sequoia Group, that's one that I'm familiar with. Some of these might have, discontinued. Intel Capital, obviously, is the venture capital group associated with Intel. Okay. A lot of very large companies like Google, for example, Alphabet, a company Alphabet now. It's called Alphabet even though it's more commonly known as Google. The reason they changed their name to Alphabet is because it's a collection of companies. They didn't want to just be pigeonholed as Google and Google only, although that's what they're most well known for, and that's where most of their revenues come from. So they changed their name to Alphabet. They are very active in the venture capital private equity space, throwing money at different projects and ideas, and accomplishing some ownership, when they do that in each one of those companies. So if they do well, they stand to benefit. But a lot of times these companies don't turn out too. So you can see venture capital in the United States, 2000 was basically the peak of venture capital. A lot of that had to do with the dot-com bubble, right? So you had a lot of companies that were coming into being using the internet to sell different products and services, and venture capital was basically focused on throwing money at those companies, whether or not they were profitable or not. That dot-com broke on us, right? The bubble burst. And then we had 9/11, and then it took quite a bit of time after 2001 to even get some investments back, a little bit more normalized, but we're not even close as far as a bubble is concerned to back where we were. Even if this could go out to 2016 and show you a year-to-date number and include the last 5 or 6 years, we're still not even close to levels like we were back in 2000 with that bubble. Okay. And we have private equity firms that organize much like VCs, but they usually invest in the equity of a company, of a privately held firm instead of a startup. So VCs can be in the startup phase and help them transition along. Private equity usually comes in and throws money in order to accomplish some ownership of a private company. Sometimes it's a company that will go public. Sometimes it's not at all. So once again, back to the example of Dell. When Michael Dell wanted to take his company back private, he needed a lot more money than even he has access to, and he's done very well. So there was a private equity group or two that came in with him, and in conjunction or in tandem with him, in cooperation with him, they were able to take Dell and buy out the majority of the shareholders to take the company back private. So then you have leveraged buyout deals, and basically this is a situation where companies will use a bunch of debt in order to buy into a company. And usually this has to be a company that's well run, has significant cash flow, profitability, consistent cash flows and profitability in order to allow a company to borrow, in order to make the deal work. Here are some of the biggest private equity funds. Carlyle Group's one that I'm very familiar with. KKR is a big one. Blackstone's a big one. Goldman, of course, is a big one. Anyway, a lot of these companies are ones that you'd be familiar with if you were in the small business world trying to get capital. One thing to point out real quick, the top one here is $50 billion, if you'll notice. When we looked at the VCs, the top one here, 800 deals at $8 million per deal on average, so they've invested about $870 million, right? So under $1 billion by New Enterprise Associates is the largest VC firm. Back at angel investors, a lot of these will be like an investment of like $25,000, okay? Very small. So these leveraged buyout deals are huge, very, very big, billions and billions of dollars. Some of them are multiples of billions of dollars even in one deal. You got institutional investors like pension funds and insurance companies that are very large investors. You got corporate investors, like, for example, Yahoo. Although it's kind of a bust as a company here in the United States, they were a significant owner in one of the largest Chinese search engine sites. And actually, one of the only reasons that Yahoo even still exists is because of their influx of capital, their investment into a company in China that's done very, very well. This talks about different kinds of stock issuances. And basically, we want to, okay, so here we go. So we got IPOs, right? Initial public offerings. We talked about this. This is the process of selling stock to the public for the very first time. Now, private companies have stock ownership, right? Even if you're a private company, you have stock ownership. But they're not readily available to the public. And if you're an owner of private company stock, the only real marketplace you have to sell your stock is the folks who currently own it, or if it just happens to be an outside investor that's interested in buying your shares, but that's very, very uncommon. So, for example, at this point, there's no marketplace to buy Dell shares. I can't just go out and buy Dell computer shares because they're a private company. There's still stock in Dell, but it's not a publicly traded company that I can invest in. If you're, here in Utah, a big private company here in Utah is the Larry H. Miller Group that owns the Utah Jazz and owns a bunch of auto dealerships and owns, a bunch of theaters, all kinds of different things. And the point is, if I wanted to buy into the Larry H. Miller Group, I couldn't, right? Because there's no public forum or public marketplace or exchange where I can buy into their shares. The only way I can buy their shares is if somebody at the company would allow me to buy their shares. And most privately held companies have very significant restrictions on who can buy their shares. For example, it might say something like, if you're not a current employee or executive or board member, you have no right to purchase the shares, right? So something like that is restrictive and keeps outside folks from gaining control of a company that's privately held. So there's some pros and cons of an initial public offering or going public. Obviously, you get greater liquidity if you go public. It's a great way to basically fundraise, right? But and of course, you have better access to additional capital because you can issue even additional shares if you'd like. It's dilutive to the current shareholders, so current shareholders don't necessarily like that. But it's an opportunity for you to raise additional capital and resources in order to grow your business. And if you ultimately grow the business substantially, then the existing shareholders that got diluted by you issuing additional shares won't be as frustrated with that situation. There are some significant disadvantages, though. One is you become much more dispersed ownership. So you might go from like 5 or 10 or 20 owners of a privately held company, within a family, for example, to thousands or even millions of owners that don't necessarily have your best interest at heart. They're not loyal to the company. They'll sell out at any point. And they're not, day in and day out trying to help the company either. So it dilutes or diversifies, the holders of the company. And sometimes that's not a great thing. Sometimes you can have somebody buy in to a substantial share of the shares, a substantial stake of the shares, and that person may be interested in putting board members on the board that just want to increase dividends or do something that maybe is not in the best interest of the company as far as growth is concerned. So it can kind of derail the goals of the company if a publicly held company loses its control. And then obviously there are a lot of requirements and regulations and costs associated with being a publicly held company, not the least of which as a disadvantage is what we referred to earlier in terms of Dell, which is these companies have to publicly report all their financials and prepare financials and have their financials audited at least on a quarterly basis. And because of that, there's a high pressure to make sure that your quarterly numbers look good. And so it creates a culture within corporate America where these companies are laser focused on trying to get short-term results. And if you're laser focused in anything in life at short-term results, a lot of times that will sabotage your ability to accomplish long-term sustainable growth, right? Because it's one thing to get short-term growth, but you might be overlooking something or valuing something that's a significant resource or significant key to your long-term success as far as growing the business long-term successfully. All right. Largest public raises, we talked about Visa as the #1 of all time, at least through the date of this being published. And of course, Facebook is a big one. General Motors is a little bit of a misnomer because you recall GM has existed for a very long time, but the only reason they went public again is because when the government bailed them out, they eliminated all current shareholders and reissued new stock in order to basically seed fund the new company and pay back the government for their bailout. So kind of a weird one. You have underwriters, investment banks that do it, and you have primary offerings and then secondary offerings after you've already gotten it. This talks about how investment banks underwrite how the pricing is established, and it gives you a list of some of the lead underwriters in the United States. Now, this list, most of the players on this list are still in the top 10 as far as companies that underwrite, IPOs. But from year to year, this list changes pretty dramatically just based on some of the bigger issues. So if you raise one of the biggest issues, for example, like if you were on Facebook or if you were on Visa, that basically made your year, as an investment bank. Even though you might have 70 or 80 other issues, they're probably a lot smaller on average. Okay, I think that's all we're going to cover tonight from the slides. So let's go ahead and cover topics that you need to know for the test, and then we'll wrap it up tonight and wish you luck this week on the final. All right, so as I mentioned earlier, a lot of repeat questions on the test, but they're all still in the same format that we've had so far in this class, which is true, false, and multiple choice. So I don't know offhand the number of each, but that's the format of the test. 90 problems, 2 points each, and true, false, and then multiple choice. Sorry, I need to get a drink a little more often than normal tonight. I've got a little frog in my throat, I think. All right, so we got 90 different problems to cover. I'm going to go through this fairly quickly so we have time to get all the topics. And I will, obviously, if it's a repeat question, I will let you know, if I can recognize it from a previous test, but still, you'll still want to make sure that you know that topic just in case it's material that, weeks later, you might not remember it, right? So if it were me, I'd be taking topic notes like I did in the previous weeks, if it were me. But this time, I've got to know that I can go back to all these different chapters that we've covered so far because it's comprehensive, to make sure that we know what's going to be on there. Okay. All right, real quick, sorry. Okay, sorry, I had to check something real quick. So first problem on the test, number 1 on the test. You want to know what the goal, this is a repeat question, but you want to know the goal from previous weeks, what the goal of a financial manager is. What is the overarching goal or objective of a financial manager within a company? And we refer to this as the value maximization principle, but just make sure and refresh on what the goal, what is the overarching main objective of a financial manager when it comes to managing a company and their decisions. You want to be able to define incremental earnings. This is something we talked about last week when it comes to pro forma, establishing pro forma. What are incremental earnings? Number 3 on the test, we want to make sure we understand what insurance is, why we use insurance when it comes to business. Just what does the book have to say about insurance and why do we use it when it comes to business? How is it important? Number 4 is about risk management. So we want to understand what the book has to say about hedging. What are we doing when we hedge based on futures contracts, and why do we do it? Okay, we want to understand hedging and why we're doing it from a risk management standpoint. Number 5 on the test is a bit of a math problem. It's a scenario where you're going to be calculating the incremental free cash flow. So it's going to give you a couple numbers. It's not difficult math. It's not complicated math, but it is asking you to do a simple equation. So we'll need to know what the equation is for calculating the incremental free cash flow. Okay, the incremental free cash flow. Want to know what the definition of equity in a firm is? So when we talk about equity, what are we talking about? Usually we talk about assets and liabilities, and then we have equity on a balance sheet, right? So what is equity? We want to understand a little bit more about insurance and taxation. Okay. Make sure we understand how insurance and taxation work. Okay, what the book has to say about how taxes and insurance interact with each other. Make sure you understand what just-in-time inventory management is. What is just-in-time, or JIT, or just-in-time inventory management? Okay. Make sure we understand how we can manage cash flow shocks, seasonal cash flow shocks. Okay. So a lot of companies have seasonal impacts, right? Even your biggest companies that are always selling a lot of products still have, usually, especially if they're retail, have a good season, right? Around the holidays, that Thanksgiving to Christmas is the significant season. Okay, so there's seasonalities with almost every business. So what does the book have to say in the short term about preparing for short-term shocks? Okay, like seasonalities, and what do you do to prepare for that? What does the book have to say about that? You'll want to know the difference between, and some of the examples on, aggressive versus conservative financing. Okay, so if you as a company have aggressive or conservative financing policy, what does that mean? And be able to identify, some examples of an aggressive financing policy versus a conservative financing policy. What does the book have to say on that? Another problem on 11 about hedging using futures contracts. So just want to read what the book has to say about what are futures contracts and why, as a company, would we use them as a hedge. What is the difference between the risk-adjusted rate and the risk-free rate? What is the risk-adjusted rate and what is the risk-free rate? Okay, what are those? Number 13 is something that would have been from tonight's material from chapter 23. It's basically requiring that you understand the pros and cons, or the main advantages and disadvantages, to debt financing over or versus equity financing. So we talked tonight about the pros and cons of equity financing. If you understand those, and then you go and find out what the pros and cons basically of debt financing are, then you'll get that one right on the test. Number 14 on the test, another question about aggressive financing policy. We want to know the difference between aggressive financing policy and conservative financing policy. And if you've got that, you've got now 2 right on the test. We want to understand, for purposes of number 15, what adverse selection is. Got 2 different problems for adverse selection. Adverse selection. And just so you know, those are short answer questions. You need to be able to write it out. Okay. And I want it to sound like your words, not just a cut and paste job or a copy job from online, right? So make sure you understand basically what adverse selection is so you can answer that short answer question. So we've got a few different differently formatted questions on this week's test than we have in the past. We got a couple short answer questions where in the past we just had true, false, and multiple choice. We are running into some short answer questions here, just as another heads up. Make sure you understand what a moral hazard is when it comes to insurance. So when the book starts to talk about insurance and why there's a need for insurance, one of the terms that is an insurance term is moral hazard, and we need to understand what that is before we get to number 17. Number 18 on the test, what is permanent working capital? We've got short-term or temporary working capital, and then we've got permanent working capital. What is permanent working capital? Be able to define it for a short answer question. Number 19 is another incremental free cash flow problem. Okay, basic information given, and then you're just plugging it in to see what the incremental free cash flow of that situation is. Number 20 is a real basic problem to calculate the insurance premium. Okay, so the book's going to give you a formula for calculating what the proposed premium would be for a policy based on protecting a certain occurrence that has a certain probability of occurring, right? And then it helps you to be able to get to what the premium is going to be. Number 21 is a kind of a repeat question because it's asking you to define what moral hazard is. Okay. Number 22, you want to understand how, when it comes to debt financing, whether or not private debt can be bonds or whether or not it can't be bonds unless it's public debt. Okay. Can bonds be private debt and public debt, or are they just public debt? You'll want to know that before you get to number 22 on the test. Number 23 on the test Incremental earnings again, you want to know what the book had to say about incremental earnings and projecting incremental earnings. Number 24 on the test talks about hedging again, but this time instead of talking about hedging in terms of futures contracts, it talks about just generally whether or not firms can use, different real commodities in order to hedge, period. Okay. Number 25 is asking you to define discount period. What is a discount period? Number 26 is another question about difference between conservative financing and aggressive financing policy. So really be clear from the book what it has to say about aggressive financing policy versus conservative financing policy. Number 27 on the test, when talking about futures contracts and hedging, what does it mean when we talk about margin? Okay, what does the term margin mean? You want to understand what a prospectus is. What is a prospectus? For an IPO or for a bond offering, either one, initial public offering for equities or a public offering for bonds. What is the prospectus? What is it trying to accomplish? What is the capital structure of a firm? You need to be able to define what the capital structure of a firm is. Quite a few short answer questions. I apologize. I made it sound like it was just true, false, and multiple choice, but there are quite a few short answer questions. You want to know what positive cash flow shocks are. So there's negative cash flow shocks and positive cash flow shocks. Just make sure you understand what the book has to say about what positive cash flow shocks are. Okay. Be able to define that so that you can do that once you get to the test. Be able to define what the book has to say about a perfect capital market. What is a perfect capital market? Okay. All right, another free cash flow problem. Short calculation on just calculating out free cash flow change based on projections. We talk about hedging again. We want to make sure we understand what storage is. What does storage have to do with hedging? How does it impact hedging? Number 34 is an insurance premium problem again. So just we told you earlier there was a problem, just a real basic, there's a very basic formula. It's not hard. And it's the way that you calculate insurance premiums that the book tells you about. And it's a little bit oversimplified, but that's okay. And the point of it is we want to make sure we understand how we could calculate or get to what should be the premium. If we understand that understand that equation, then if we run a business and we have an insurance company that's proposing insurance and it's significantly different than what this calculation gives us, that gives us a little bit of leverage to either renegotiate that or be excited to accept it if we're way off and they're way less expensive, because that formula is a good formula to measure what the price should be for protecting risk. So number 36 talks about long-term financial planning. So what is the point of long-term financial planning when it comes to business strategy? You want to know what the book has to say about what the objective of long-term financial planning is for a business. What are we trying to accomplish? What does it cover? Number 37 is another question on financing policy. We talked about conservative versus aggressive. Just understand the difference between aggressive and conservative financing policy. That'll be another one right on the test. So that's one of those reoccurring themes that I'd make sure that I had down, because you're going to see it a couple different times. Let me just take a quick drink. Number 38 is just we want to understand the basics of capital raising through debt. and whether or not it's uniform from one industry to another or one category of company to another. Okay, is that a uniform thing where everybody does the same kind of debt raising, or is it very unique based on one company to another, even if they're in the same industry? So you want to know what the book has to say about debt capital raising or capital raising using debt and how it varies or how it's uniform from one company to the next. You'll want to know what the NPV or the net present value of premiums is when it comes to insurance. Okay, what is the NPV or net present value of premiums or projected premiums when it comes to insurance? You want to be able to define what key person insurance is. What is key person insurance? Okay. You want to know what the steps are once you're establishing a business after you establish a credit policy. Okay. So once again, this is a reoccurring theme again with credit policy where we talk about, aggressive and conservative credit policy, but then we also talk about the steps of developing credit policy for a company. And once you've developed or established a credit policy, what do you do next? What does the book have to say about what you do next after you establish a credit policy? When it comes to a public offering of bonds, so we talked about an IPO tonight on equities, but when it comes to a public offering on bonds, what is an indenture bond? What is an indenture bond? You want to know the definition of temporary working capital? We talked about permanent working capital. You just need to be able to define both before you get to the test, and you'll get that one right. Make sure you understand for capital budgeting. This would have been from last week. If you're making capital budgeting decisions, what's the correct tax rate? How do you establish what the correct tax rate is to assume when you're doing capital budgeting? And also be able to answer what is a credit period. It's a short answer question. What is a credit period? Number 46 has to do with what we're learning about this week, which is capital raise and having sufficient capital in your business, being sufficiently capitalized, as you could say it. What are some different ways that we use to be sufficiently capitalized? Okay. Obviously, we have talked about a couple. We talked about one of them tonight. We've referred to a couple of them. Just make sure you understand what the concept is of capital raise and why it's important, why companies do it, and then how do they do it. Okay. And just a hint, it's not the traditional method that you and I do it by just going into a bank, right? Companies need a lot more than banks to make it work. Number 47 has to do with seasonalities. Just make sure you understand what the book has to say about seasonalities. Number 48 is a free cash flow problem. Basic information, you're just plugging into a basic problem to calculate free cash flow. Make sure you understand why we use cash flow forecasts. What's the point? Why are we trying to forecast what cash flow will do, even though a lot of times we're wrong, right, in our guessing? Why is it so important that we can try and analyze and then try to project where cash flows will be? Number 50, we want to know about leveraged cash flows versus unleveraged cash flows when it comes to buying out a firm, and why is that so important? Okay, if I'm a buyer of a company, why am I so interested in the unlevered cash flow? If you know what the book has to say about that, you'll be in good shape on that one. 51 is a seasonality problem again. Number 52 is from the statements from the chapter on financial statements. You want to know the difference between like percent of sales method, percent of assets method, percent of income method, percent of liabilities method. These are different calculations for comparing financials on a statement. If you know those basic differences between those, you'll get number 52 right. 53 is just a definition again for permanent working capital. We've already seen that, so you'll have at least 3 problems right between permanent and temporary working capital. You want to know the advantages and disadvantages of private debt over public debt. So you can go out and get a private loan, or you can raise, like through a public offering like we talked about on the stock side, but in this case it'd be bonds, and raise public debt. What are the difference between the two? Why is one more advantageous over another? What are the pros and cons of each? You want to be able to give a short answer about business liability insurance, what it is, why it's important. You want to be able to identify the 5 C's of credit. When we talk about establishing a credit policy, we talk about the 5 C's of credit. Want to be able to identify those. Want to understand what a futures contract is for 57. Want to understand what a cash discount is. Okay, what is a cash discount? When it comes to your payables and your different vendors that you use, what is this cash discount? Make sure and understand that concept. It's just a basic corporate finance concept. Want to understand the difference between positive and negative cash flow shocks. That came up before, so we definitely want to pay close attention to that. On 60, we're just talking about value maximization principle again, as far as financial managers, why and how they make decisions. What is that overarching principle when it comes to decision making for a company from a financial manager? Let's make sure we're clear on that. Make sure you understand what types of companies would need more temporary working capital versus other companies that would need less temporary working capital. Okay. There's some examples of both when you're reading about short-term and long-term capital financing, or working capital, excuse me. Just know the difference between debt and equity raises. Incremental cash flow question on 63. So another one of those. Number 64, you just want to know the basics of financial planning, corporate financial planning. What are the steps? Okay, for corporate financial planning, both short-term and long-term corporate financial planning. Number 65 on the test is 2800. The answer is 2800. It's not a formula that we're going to look at or require you to know. Number 66 on the test, you'll need to know, once again, positive and negative cash flow shocks, and then what seasonalities are. We've heard all those concepts before. We want to make sure and get those ready before you get to the test, because there's quite a few questions. Want to understand what the primary reason for risk management is, or what the primary method, of risk management is for corporations. What is the primary method of risk management for corporations? Make sure you understand what business interruption insurance is. If you have a fire or something like that at a business, what does business interruption insurance do? How do you calculate the debt to value of a company? Once again, a short answer question about negative cash flow shocks, what they are. And I think that's where we'll end. There's about 20 more problems on the test that I didn't cover, but you've got the chapters, you've got the material, you should be in good shape. There are quite a few themes that kept reoccurring as far as information the test really wants you to know. It seems like negative and positive cash flow shocks and seasonalities were a theme. It seems like incremental cash flow problems, there's about 5 or 6 cash flow problems, just basic information. There were at least a couple problems on calculating insurance premium, where insurance premium should be. How do we calculate that? There were quite a few problems on credit policy, aggressive versus conservative credit policy, so we'll make sure that we feel comfortable with those. Okay. All right, have a great week this week. Good luck with the test. Let me know, Cayenne, if you get stuck on anything, especially with those assignments. I'm anxious to see those and grade those and get you those points. And good luck this week. Let me know if you have any questions or concerns as we go through the course. As we wrap up, I just wish you the best of luck finishing out your MBA, and best of health as well to you. Have a great night.